Okay, guys, we're gonna get started. Sorry to our online people. We have a lunch and learn today, so we're just grabbing some sandwiches and taking a seat. But we're really excited for today. We've got a lot of people in person, big audience online, but we thought it'd be a good time to have in some lending people to talk all about alternative lending, reverse mortgages, and I guess like some situations for our less, or I guess our more complicated clients, including ourselves too. So I think it's gonna be a really informative session. We will record this, so we'll do our best. I know sometimes our speakers forget we're online sometimes too, but we'll try to do a good job for you guys online, and then we'll have it all recorded up on the YouTube channel. So some of you guys recognize Varan. He's hiding off in the corner here.
Hey guys.
You guys get to see Varan a lot, but he brought in some extra help today from, I think it's Equitable Bank. So hopefully you guys get some questions answered. If you guys got some specific scenarios, this would be a really great time to ask the experts. So we're going to get started. Did you guys want to do a quick intro before I jump into the slides, or? Okay, go. Right here where they can see themselves. You guys will see yourselves on camera.
Good morning, guys, and thanks for being here. And as most of you know, my name is Van from Iconic Mortgages. I brought a Equitable Bank to speak about alternate lending and reverse mortgages. You know, we all know about what the banks can do, so it will be a tool for you guys to help your business. Even it may be an option for you guys personally as well, because the lending is getting very complex. So that's why I brought the lenders to talk about what they can offer and what are the advantage. And there's a stigma about going to the alternate lending and reverse mortgages as well. So let's kind of talk over today, and that's the whole purpose. And I'm going to hand the floor over to Andrew from Equitable.
Perfect. Awesome. Thank you. Morning, everyone. Nice to see everybody. My name's Andrew, Equitable Bank. I cover our alternative suite of products, which includes business for self, in rental properties, imperfect credit scenarios. So I'm going to talk a little bit about each scenario.
I will whip up our PowerPoint.
So just a little, sorry. Right in
Yes,
front?
sorry,
Okay,
right here.
perfect. Right up close? Okay, all right.
I've done this so many times.
Yeah?
I know
Okay.
that once we become clear on that.
Okay, got it. No problem.
And we can see behind it.
Okay, sounds good.
Next.
Yeah, let's go to the next slide. Next one? Yeah, okay, cool.
Just
Actually, can I go like that or not?
this one.
Okay, a little bit about Equitable Bank. So we are a Schedule I bank. We're actually the 7th largest bank in Canada by assets, where we have alternative products coast to coast. We lend national within Canada. We have about $115 billion in combined assets under management and administration. We're a big bank. We're growing. We've purchased recently Concentra Financial, which is a credit union. So we definitely do believe in the alternative banking system, and we are here for the long run to continue providing solutions for your clients. So just a little bit about our profile. The bread and butter within Equitable Bank is our alternative suite of products, as well as reverse mortgages. Those are the products that we're most aggressive with, and we provide the best solutions for your clients. So when it comes to our alternative suite, we do business for self clients. We have some very neat ways of packaging business for self deals for your clients. I'll go a little bit in depth with that. We also do real estate investors, clients that are purchasing their 5th, their 6th, their 7th, their 8th rental property. Maybe the A banks will turn them down, or maybe we'll offer a lower LTV. We can be competitive and do a higher LTV. Bruised credits, obviously, as an alternative lender, we can entertain clients that have, maybe are in consumer proposal, maybe they've been discharged from bankruptcy. We can look at all those alternative situations. Also, newcomers to Canada is a focus as well. We also do have some value-added programs, including an alternative line of credit, some other solutions to help package your client. Let's say your client has solid net worth. We can do elevated ratios and package your client that way. So a little bit about our business for self program. We don't ask for T1s. We don't ask for notice of assessments. The way we evaluate your client is by using bank statements. 95% of our deals are done with business bank statements or personal bank statements, okay? I don't need a 2-year established history for your client. All I need is 1 year established, 12 months bank statements. We can get away and do the deal. Versus other lenders, A lenders may look for a 2-year history. They may look for 2 years T1s or NOA returns, whereas we're just set with bank statements. And the beauty about looking at bank statements is we look at the income that's coming in, as well as the common expenses that are coming out relative to that business, okay? So right there, right then and there, we establish a comfort level as to how much you can utilize to qualify your deal. So just as a very rough example, let's say you have a restaurant owner, okay? Lots of deposits are coming in, expenses are heavy, they're coming out, but the top 5 expenses probably for a restaurant would be a lease payment, probably salaries, cost of sales, utilities, and things like that. So what we'll do is we'll do a thorough review of the 12 months bank statements, total tally up those expenses, tally up the income that's coming in. The income can be deposits, it could be wire transfers, it could be e-transfers, things like that. Something that's consistent and fits the business profile. That's what we would add up, and then the difference is basically the income that you use to qualify. Okay. We can also look at business financials as well. Okay, that's another route that we can take. We look at commission income letters. We look at contracts. Foreign income is done on a case-by-case basis. The beauty about us as an alternative lender as well is we don't have a cap as to how much your client can gift, or sorry, can receive as a gift. And it doesn't have to be from an immediate family member. It can be from a cousin, it can be from a distant cousin. As long as it's disclosed to us up front and the amount is disclosed, we should be able to proceed. Okay. Some of the other situations that we look at, registered versus non-registered businesses, clients, again, that are new to Canada, maybe they're transferring their business over from from overseas over to Canada, clients with limited credit history. I don't need to see established credit on the B side, okay? We do have a flexible GDS, TDS. We are aggressive with this, and we can entertain owner-occupied as well as rental properties under our alternative program. Our standard amortization is 30 years. And we don't have a cap as to how much we can lend to your client. Okay, as long as the profile fits, we can entertain it in the GTA, larger loan amounts, provided that we have a solid business profile for your client. Okay. So examples with registered, non-registered businesses. I already gave you a registered business example, but one non-registered business example that would apply is specifically when it comes to realtor income. Okay. The way we look at realtor income is a lot different from other lenders. So what I want to see typically is this year's commission statement showing pending trades and everything that's been completed, as well as last year's commission statement. Okay. So what we do is a 12-month look back. So we tally up everything that you've earned over the last 12 months, and that's the income that we can utilize to qualify. Okay. There will barely be any expenses. So the only expenses that we typically take for a realtor is a cell phone bill, maybe a membership fee, and that's about it. I've done deals using 97% of that total income to qualify the deal. Okay. So it becomes very aggressive when it comes to that. What we do look for, aside from the 12-month history, is we look for tenure. We want to see that realtor is established and that whatever they earned in 2023 is similar to what they're going to potentially earn in 2024. Okay. Same thing would apply with commission clients, financial planners, things like that. We do a 12-month look back on income. Okay. Contract employees, IT consultants. A lot of these clients maybe were working for a Fortune 500 company. They have since become BFS. Maybe they have a 12-month history. We can utilize that to qualify. Again, those IT consultants may not have a lot of expenses. They're probably working from home. So we'd probably take a cell phone and internet expense, and that's about it. Okay. Gratuity-based income as well. If your client is a waiter or a waitress, what we'll typically ask for is a job letter showing that they're being paid, as well as there's a gratuity component. As long as the client's depositing that commission or those tips into a bank account, we can utilize 100% of that to qualify your deal. When it comes to investor programs, we have a really attractive rental property program. We can go as high as 80% LTV, 20% down payment on a rental deal. Again, this is coast-to-coast lending at that LTV. We can do mortgages under a holding company name with a personal guarantee. The max number of units that we'll entertain at Equitable is 10. The applicable type of clientele that we're looking for here is BFS or salaried clients, as long as there's income being generated. If it's within our TDS, GDS guidelines, we should be able to do the deal. What we look at for a subject rental is a 95% add back to income. So we'll take 95% of that potential rental income being earned, add that back to the file and use that as income. If for any non-subject properties, like let's say your client has a large portfolio of rental properties, we'll do a 95% offset. So we'll offset the potential rental income being earned, offsetting it against the PITH. Okay. We'll also entertain up to a maximum of fourplex. Anything larger than a fourplex goes to our commercial side.
Clear like what, please? Clear like.
Just a couple of imperfect credit scenarios. So obviously, as an alternative lender, we do have these solutions, unique personal circumstances, divorces, illnesses, loss of jobs. We do spousal buyouts on our alternative side. Clients that have arrived to Canada, maybe they don't have that 1 or 2 year established credit history, but they've landed a good job relative to what they were doing in their country of origin. As long as we can confirm it with a job letter and it's a professional company that we can Google, we can utilize that income without any credit. Also, as an alternative lender, we can look at credit scores under 550, just depending on what's happened in that scenario. If it's pride and ownership, we can entertain those deals. If it's a refinance, maybe your client is in a private, maybe they have a first with another lender and then a B private. As long as payments have been maintained, at that point, we don't really care about the credit score. Okay. We'll help them. We'll put them in a better situation. I've even had a situation where we've offered, client had a 489 beacon score. They were at capacity with all their credits, but however, they maintained their mortgage payment A1. Started to see a couple of missed credit card payments here and there. What we did though, we gave them a shot. We gave them a chance, 75% LTV. We did a refinance. We cleared up everything. We even offered them a line of credit just so they can start rebuilding their credit. Okay. Idea there is to put them in a 1 year with us, see what happens after that 1 year. Maybe we can offer them a better rate. Maybe they have a chance to go to the A side after that. Okay. Any questions with regards to our alternative suite of products?
Andrew,
Yeah.
maybe we can share some experience, some of the deals that we have done together. So it's
Yeah, absolutely.
So I'll try to
100%.
walk you through a couple of the deals I have done. It's come to my memory. I had a client, he actually left the Scotia Bank and he started a transportation company with Amazon. And his yearly revenue was about $5 million.
Yeah, I remember that.
He was a $5 million. He bought us something for a property. So I had a client, he left the bank and IT consulting and he started a job with Amazon as a route delivery. So he was doing the routes for Amazon. But if I had to take him to the bank, I also work with the bank, TD Scotia and BMO, we needed 2 year history. His revenue was $5 million.
5 million, yeah.
It doesn't matter how much revenue, he couldn't go to the bank. He bought a principal home. So we took to Equitable for 2 years. When he has a 2 year income filed and we have a tax return for 2 years, then we were able to move it back to the bank. So these guys are not the permanent solution for the client. Most of the terms are 1 to 3 years.
I would say so, yeah.
And mostly 1 year term. It's an interim solution.
Yeah. And it's all about mitigating. Like in that situation that Varan just mentioned, we looked at the overall profile of the client. We saw that they had a really good credit score. There's a lot of potential earning opportunity here. And we only had, I think at that point, we had what, 6 months, 3 months bank statements.
It's about 6 months bank statement.
So
he was 6 months into the business. There's no way, like he has a very strong profile.
Yeah.
The banks will never fund him. So he would have had to wait for 2 years to get into the to get a mortgage to go with the traditional bank.
And that's a perfect solution. We put them with us for 1 or 2 years, see what happens after, take it to the A side. Like at the end of the day, professionals like that, we don't want to keep them on the alternative side, although that's what we're seeing right now, just given the high interest rates and all that. However, if there's potential to move it over to the A side, absolutely, by all means. So we look at it, especially with a business for self client, we look at it as a stepping stone, do it with us for a year, for 2 years, for 3 years, let yourself get established, report whatever income you need to report on your notice of assessment so that later on you can qualify on the A side.
What's the premium on the B side?
So all our rates come standard with a 1% lender fee. However, as of right now, our best pricing is about 6.59 on a 1 year. So really we're about 50 to 75 basis points higher than an A lender, but it's just in terms of aggressiveness, in terms of finding the solutions for a typical BFS client, at the end of the day, they don't really care about the rate, they care about the solution.
Is that 6.59 across the board, or is that selective? Or
It's depending on beacon score and overall risk of the file. So assuming it's on, yeah, it could go higher, yeah.
Also, there's a premium for the rental properties.
That's right. There's 50 basis points added for a rental deal. Just keep in mind also right now, our 3 year adjustable for qualified clients of 680 plus beacon scores is prime minus 30. Unheard of in the B space. Usually B lenders don't even have an adjustable rate mortgage, or if they do, it's prime plus pricing. We're at prime minus 30. We're in competition with A lenders.
That's almost a bank rate.
Yeah. That's a 3 year adjustable. The good thing about
the premium for paying the 1%.
Yeah, you're still paying a 1% fee. Yeah. But you get to play the market, you get to see if Bank of Canada goes down, and instead of your Rate going higher, like it was a year, 2 years ago, your rate's going down slightly.
Also, we have helped some of the realtors being in the business not for 2 years. You don't have established history to go with the bank. So they can work with their 1 year T4 or a
Yep.
complete statement.
Yeah, I don't even look at T4s.
The commission.
It's much easier to look at commission statements. We see what your earning potential is this year. We see what you earned last year. It gives our team a little bit more of a comfort level to see over the last 12 months how much you've earned, especially if you have a pending trades over the that are going to close this year. Gives us a lot more comfort level to lend.
So it's not really your net income, because it goes from 100% to about 60% maybe after your deduction, whatever.
Exactly.
You're saying about 95%.
Yeah. Yeah, exactly. I've done deals with 97% of whatever you're earning on your commission statement.
What about if they spend it all? You guys are looking at bank statements, I guess.
We're not really looking at bank statements for a realtor deal. I mean, if it's a purchase, we're just looking at down payment history. That's about it. We know realtors, the expenses are very limited. A lot of it is probably personal expenses as well. So again, just a membership fee and a cell phone bill. That's all that will take.
So the difference between the banks and alternate lending, the banks use the traditional income, which is T1s and notes of assessment for the business for stuff. They lend mostly based on cash flow, which is a business did.
Cash flow, earning opportunity in the next 12 months. Absolutely. That's what we look at. Continuity of income is huge. Like if we have a realtor situation, like let's say they earned 300,000 last year, this year they're only at 25,000, but you need to use 250 to qualify. That's where it kind of doesn't make too much sense. Like we want to make sure that the realtor, obviously given the market conditions, they're on track or at least close to earning what they earned last year.
Do they take assets and?
Yeah, absolutely. We can package a deal with assets. So our net worth program, just very quickly, high level, applicable to owner occupied properties. What we'll do is we'll take 25% of the loan amount and we'll utilize that as liquid assets. So RSPs, 100% of the recent market value, cash accounts, TFSAs, investment accounts. We'll utilize all that. If it's 25% and it qualifies, we can let your ratios go all the way up to 65 TDS. Whereas our typical hard stop is 50. While maintaining the same pricing, while giving you an opportunity to get 80% LTV lending.
And also the other side is if you work with a client who's going to a separation and they have a bad credit score, they have missed some payments, but they are financially strong in terms of the income. So they will take sub 600 credit score, which is an opportunity for you guys to finding a rental. You may be able to find them a property for the proceeds of the sale. So there are few clients we work like that is actually a solution rather than putting them in a rental. You can able
Absolutely.
to
Absolutely.
home ownership.
How much of the rental is put into?
95%.
95%?
Yeah, yeah. No, not 50. A lenders are at 50.
Okay.
Some may differ. B side lending is 95%.
So
Absolutely.
that's still for.
It's
At the end of the day, it's a
risk-based
trade-off,
pricing.
right?
It's a
It's a
risk-based
solution.
pricing.
Yeah.
So their rates are high, there's a fees because the risk-based
Yeah,
pricing.
but there's more solutions that we can entertain for your client. Yeah.
So yes, and on the side for self-employed.
Usually the max is 50-50. There are some solutions that we have where we can go to 65 or even 60, just depending on the overall scenario.
That depends on the net worth and the down payment.
Yeah, absolutely. Okay. Awesome.
Any questions? Any questions for Andrew?
Perfect.
You can even write them down. We can do some more at the end.
Yeah, we can answer at the end. With that being said, I'm going to bring on Sean to talk about reverse mortgages. Take it away, Sean.
You
Hi, everybody. My name is Shan Dimel. I'm the channel manager at Equitable Bank for reverse mortgages. I've been in the reverse mortgage space. You're getting my presentation up?
Yeah.
I've been in the reverse mortgage space for around 6 years or so. Previous to being at Equitable, I used to be at Home Equity Bank, where you would have seen a lot of advertisements with Kurt Browning, stuff like that. So reverse mortgages have been here for a long, long time. One thing I can assure all of you today, I'll guarantee you one thing, you will learn something about reverse mortgages. Number two is some of you might look at this product and say, this is not right for me or for my mom or for my family. And I fully respect that. Absolutely. It's not for everybody. Reverse mortgages are not for everybody. However, I will also prove to you that it is a product which has changed over the years. The perception is changed. There's a lot of myths out there, and it is becoming extremely popular. And I'll tell you why it's becoming popular as well. So very quickly, show of hands, who has heard about reverse mortgages? Okay, good. Majority have heard about reverse mortgages, and I'm sure you would have heard some either really good or some really, really bad stuff about it as well. All of you are realtors. How many of you know of clients who are sitting on tons of equity who are not ready to move yet? Mostly, I didn't see a show of hands, but I would say a lot of you might know those types of people. Reverse mortgages can help. How can it help? It might be able to, you might be able to sort of potentially show them a solution where they can tap into some of that equity and maybe utilize it for a rental property, for an inheritance, so on and so forth. So with that, if you want to turn the slide, I'll quickly start off with a quick story. I did a presentation like this. The largest reverse mortgage I have personally ever done, this was with my previous company though, was after a session like this, a realtor reached out to the broker and said, listen, I have this client sitting on Niagara-on-the-Lake. He's a former retired professor from U of T in his late 80s. His mind was brilliant. He had this amazing property worth around $8.5 million on Niagara-on-the-Lake, right? He always liked real estate, but unfortunately, no one was willing to lend him any money because all he had was he had a U of T pension, CPP, and old age pension. That was his income, right? He deemed himself as an A client, so he didn't want to come to Equitable and borrow on a B space, right? However, he loved real estate. So this realtor actually presented to this prof saying, hey, Mr. Prof, you know, you can tap into some of that equity and maybe purchase yourself another rental property or something like that. He wanted to learn more about the program, obviously very intelligent gentleman. He looked at the program and decided within 24 hours that this was an amazing product. He took out a $3.5 million reverse mortgage and purchased two properties, a triplex and another property downtown Toronto as rental properties. So he basically borrowed $3.5 million. He leveraged his property and he purchased two other properties. Today, I can tell you this happened, I'm going to say pandemic time. So today I'm pretty much going to say he's sort of made all this rental income, plus he has two other properties. Yes, he owes money on his existing property as well. We'll go over that. What are we going to talk about? We talk about reverse mortgages and real estate, partnering with iConnect as to how they can help your clients as well. Okay, next page, please. Thank you. Why are reverse mortgages in demand? Couple of reasons. The desire for people to stay in their home is amazing. I've interviewed tons and tons of clients. Okay, once you hit a certain age, people don't like to move. Even if they do, I actually don't call things downsizing. I call people right sizing. If they lived in Scarborough, they might have a $2 million property, right? They might think, yeah, I want to downsize, but it's actually not, they want to right size. They still want to live in the community, right? They might not want to move. They might not want to sell their $2 million property. They might be willing to spend $1 million, but they don't want to move to Kingston or Peterborough. They still want to stay within that community. Reverse mortgages can help those individuals and help these individuals right size or downsize, right? Pensions versus increasing cost of living. Cost of living is just becoming outrageous. Here's a fact, doesn't necessarily apply to people like you, might be an opportunity. I personally feel over the next 24 months, there's going to be a lot of sales. And here's the reason why. 75% of the entire mortgage book in Canada is coming due for renewals. 75%. Think about that for a second. Out of 10 mortgages, 7.5 mortgages are going to be coming due for renewal. These are people who took their mortgages 3 years, 5 years ago at 199, 299. Today, yeah, rates are settling down, but it's still in the fives. Even in the banks, it's 5, 5.5, that range. The average payment shock which all these people will get is 40%. That's the average. So someone who's paying $1,000 on their mortgage, now their payment, when it comes up for renewal, goes up to $1,400. Now you tell me, if they're a senior, doesn't have to be senior, whose income has gone up by 40%? Realtors, maybe, you guys are self-employed, so hopefully your income has gone up. But if you're on a fixed income, it's going to be tough. So that will trigger two things. One is it will trigger these people. You can't live. It's not affordable anymore because your pensions, nothing has gone up by 40%. So that's also another factor as to why reverse mortgages are becoming popular. Investment income people, these are affluent Canadians. I work with Warren at TD. Okay, for 20 years I worked there. I was a financial planner at that at one time. If someone came in 30 years ago, right, in the early 90s, and we did a financial plan for them, did you know what age we planned it until? 80, 80. Today at 80, people are living large. At 80, people are living large, right? When you live longer, what do you run out of? Money, exactly, right? So people are running out of money, right? Canadians, that's a fact. So anyways, next page, please. Past and present. Okay, this stigma about reverse mortgages all comes from the US. I don't want to get into this whole US stigma. The company I work for, Home Equity Bank, has been doing reverse mortgages for 35 years, and they do a super bang up job. They educate the public about it. They have Kurt Browning, Peter Mansbridge, right? These are popular Canadian people. Like when Peter Mansbridge says it's a good product, people believe Peter Mansbridge, right? Kurt Browning, like, you know what? Classic Canadian individuals. So Home Equity Bank has utilized these people to sort of enhance what a reverse mortgage is all about. 10 years ago, if any one of you came and said, listen, I want to get a reverse mortgage for my mom or for my dad, you had only one choice. You could only go to Home Equity Bank because they were the only player. They monopolized the market. Monopolizing is not good because they could do whatever they want, right? I was there when I was at Home Equity Bank when Equitable Bank, which is the bank I'm working now, launched the product, and I was actually happy. Two reasons I was happy. One, it's good for the consumer. Monopoly is not good. For a consumer, competition is always a good thing. It's good for the brokers. He doesn't have to go to one bank to get this product. He has choices. What suits my client, he'll take that product to wherever it chooses. So people have choices, right? So 5 years ago, Equitable Bank got into this market, and we've been doing amazing. Quick stat, overall last year, I don't know whether this holds true for realtors, but if you ask brokerages or brokers, they'll say last year, thank God last year is behind us, because last year was not the greatest of a year when it came to mortgages. Majority of brokers, their mortgage business origination dropped. However, majority of the brokers will say my reverse mortgage business picked up. It was same for Equitable Bank as well. Equitable Bank as a whole, we didn't necessarily meet our expectations when it came to our alternate lending side. However, our reverse mortgage portfolio grew by 40%. Why? Because of some of the factors I spoke before. People are living longer, running out of cash. Next page, please. Oh, just keep clicking. I don't know why this comes this way. Yeah. Okay. All right. Perfect. Now, this is what a reverse mortgage is all about. If you get the concept on this, you understand what this reverse mortgage is all about. Very, very simple. With a regular mortgage, I don't care who the lender is, the lender demands a monthly payment. One can arrange a mortgage, TD Bank, Royal Bank, Scotia Bank, Equitable Bank. It's a regular mortgage. The lender demands a monthly payment. Whether it's principal plus interest, interest only, there is a payment which you have to make on a monthly basis. So I call those forward mortgages, right? With a reverse mortgage, there's no payments. Now, this is where usually sort of people look at me and say, hold on a second. I'm prepared to give Andrew $100,000 and Andrew doesn't have to make a single payment? No, he doesn't. Okay, what's the catch? How does Equitable Bank make money? There's something wrong in this story. Very simple. We are a bank, we make money. I collect my money for Equitable Bank when either Andrew A, he sells his property, or B, when the last spouse passes on. Let's look at that in real life today. Let's look at that in real life, okay? Let's assume Andrew was 65 years old, which is about 40 years away for him, but he's 65, he has a home in Scarborough on Kennedy Road worth $1 million. Let's just play with me on this one, okay? So today, Andrew's 65, he owns a home, Scarborough, house is worth $1 million. I lend Andrew $100,000. What does he owe me? My interest rate on a 5-year term is 6.84%. Is it high? Yeah, sure it is. It's higher than the traditional rates. My interest rates were 3.99 as well. And people said that was high, but forget about the rate. Forget about the rate. 6.84. That's a 7%. So if I lent Andrew $100,000 today, After 1 year, straight calculation at 7%, Andrew will owe me $107,000. Everyone with me so far? 100 multiplied by 7% is 107. Let's round it up to 110. Here's how reverse mortgage works. How much will Andrew owe me after 1 year? 110. Second year, 120. Third year, anybody? 30, 40, 50. As a matter of fact, exactly after 5 years, he'll owe me around $142,000. Now you tell me, all of you are realtors, right? His home, which is worth $1 million today. You think, I mean, this we don't know, but what are the odds that it's not worth $1,050,000 in 5 years? What are the odds? What's the average home appreciation in GTA? I don't know the answer to this one, but I think it's around 7% over the past 20 years, right? Wrong? 5%? Okay. Right. What term period is 5%? Okay. All right. So 5% appreciation. So you might eat into some of the appreciation, but that's the cost of doing. So this is why this product. So Andrew sells his home in 5 months' time, 5 years' time. Very simple. He'll pay Equitable Bank the $150,000 he owes, and the remaining money is his. People think when you do a reverse mortgage, the lender owns the home. That's the biggest misconception out there. I'm not in the home ownership business.
Your name's on file.
Absolutely. If you get a, if you get, well, TD Bank, is TD Bank the owner if you do a TD Bank mortgage? No, TD Bank has interest on the property. They can't sell and run away. TD Bank doesn't own the property. They have, well, they can liquidate it, tell whatever they want. The remaining funds will be given to them. That's a clear difference. There's a clear difference. They are a mortgage holder of the property. It's the same thing. It's absolutely the same thing. Yes, sir. You can get out of a reverse mortgage at any time. Yes, it's closed. Up to 5 years, there are penalties, but you can get out of it at any time. 5 months interest, 4 months interest, 3 months interest. Those are penalties. If they pass on, God forbid, no penalties either. Let's not get into the technicalities. I mean, I'm more than happy to talk about it. Today, my objective is for you to understand reverse mortgages, right? It's an easy product to exit if you have to, right? Just like anything. We are a bank. We are a profitable bank. You want to get out of this contract? Sure. I'll let you get out of the contract, but you have to pay us something to get out of the contract. 5 months interest, 4 months interest, 3 months interest. That's how it works, right? Yes. Loan to values are based on the age. Very simple. The older you are, the more money I'm prepared to lend to you. Why is that? I know I'm going to collect my money back fast. Simple as that. We are a profitable bank, guys, right? We are not in this business to do charity. So if someone's 80 years old, they have a house in Scarborough, no mortgage, or let's say they have a mortgage or no mortgage, I'm prepared to lend them 59% loan to value. 59% loan to value, which is $600,000 without questions asked. I don't care about their income. Their CPP and OS, I don't care about their beacon. This is a good product for people who want to tap into this because they love it. Because if they go to the traditional, Brian's an amazing broker. But if they're 75 or 80, they have CPP and OS only. Even if the home is free and clear, he cannot get you a regular mortgage because the lender is going to say, well, there's no income, right? They are retired. They have only pension income. I can't help you. How can you tap into that equity? I have people who are starving, who are house rich, extremely cash poor. I call those people rich anyway. If you're house rich, you're rich, right? But the sad part is this. They're starving because inflation, cost of living has gone up, right? They can't afford to have 2 meals. I know of certain situations. Sadly, you can't take a brick and take it to Loblaws and say, give me some groceries for it. However, you can take a reverse mortgage, tap into some of that equity and get your life. Yeah, that's a fact, right? You can't take a brick and so anyways, loan to value is determined on age. Minimum qualifying age to qualify for a reverse mortgage is 55. So none of you will qualify in this room. 55 is the minimum qualification age.
Would a bad
Right.
bill of health help you?
I don't care. I
You
don't,
got cancer, you got a year to live, 2 years. Does that give you a better?
we
rate
don't
or-
discriminate based on, and I don't ask the fact whether you have cancer or whatever. Will you get a better rate? No. As a matter of fact, for me, I make profit more if they live longer in the property because then your interest compounds. I'm not in this for a short term. On average, our mortgages last for around 13 years. And then after that, either, God forbid, they pass. Equitable Bank's only in the 5 years in this business. How I know these facts are because I used to work at CHIP, Home Equity Bank. Average mortgage lasts around 13 years in the reverse mortgage space. So it's typically for people who want to, and we'll go over some scenarios where they want to live in the home they love, right? Now that might be counterintuitive. Yeah, can't even say that word, whatever, you know the word I'm trying to use, counterintuitive to you, because you as a realtor want them to sell this home. However, they don't want to, because reverse mortgages ideally want people to stay in their home. But we'll go through some scenarios where I can help you, right? To sort of maybe for these people to unlock some of this. Clients own their home, we got that easy qualification. Like I said, if they have CPP and OS, I don't care about anything else. It's pretty easy to qualify them. Next slide, please.
What about the renewal after 5 years?
What about it?
Do they renew?
Of course, is a regular bank, you get a renewal? I beg your pardon?
You don't force a sale. I mean,
Absolutely
other
not.
than your-
Absolutely not. It's a lifetime it's a contract for a lifetime, and I'll go through some protections that we give as well. We do not force them at all. It's a regular bank renewal. Since you asked that question, there's only 3 ways you can default on a reverse mortgage. One is you don't live in the property. It has to be your principal residence. Now, you can live in Florida. That's okay. You can rent a part of your house. That's okay. But it has to be still your principal residence. So for your tax return, this has to be deemed your principal. If it's not, you can rent it out, then you're in default. Number 2, if your property taxes are, if you owe property taxes, then you're in default, right? And number 3, you have to make sure that your home and heat insurance and you maintain the property. That's why we lend only on principal residence. The risk for Equitable Bank, people ask me, why don't I rent on rentals? It's a huge risk. I'm giving you the $100,000 I gave to Andrew. He hasn't paid me. His mortgage will double in 10 years' time. I'm hoping he's going to upkeep his property. If he just runs this place down, like I'm off on my security, right? However, when it's principal residence, for the most part, most people do take care of their principal residence because that's where you live. You have some pride of ownership, right? Where do we lend? Ontario, BC, Alberta, Quebec, major urban centers, not too much I'm going to cover here. You'll be 55 years of age, minimum property value of $250,000. So in Toronto, these are not factors. Next page, please. We covered the no payments, right? Homeowners will never be forced, to your point. Sorry. Okay, homeowners will never be forced. We covered this one as well, 59%. We lend up to 59%. Now, Andrew owns a home, $1 million worth in Scarborough. He's 80 years old. Don't come to me, well, he wants $800,000. No, I will not lend him $800,000. However, I'll lend him $59,000 pretty much without asking any questions. So he can access up to $590,000. Okay, easy to get approved. Proceeds are tax-free, just like any other mortgage. And why this is important is this, right? We have more and more affluent Canadians utilizing our product today. I'll give you a great example and I'll cover that off too. They want to give their son, daughter, somebody some extra money, right? To purchase a home, to do something, start a business. If they cash out their investments, there's capital gains, there's other implications. Maybe it's not the best time to sell your bank stock right now, right? That can have trigger so many other implications. However, with a reverse mortgage, there's no tax implications. Nothing happens to their OAS or CPP or any other income streams which they have, government assisted streams which they have, nothing happens. Next page, please. And thank you for driving. I appreciate it. Yeah, this is important. This is just a quick stat. I used to interview a lot of people. Sorry, go back to the one before. You can keep it here. That's fine. Interesting fact. I used to interview a lot of clients previously, and 90% of these people said, listen, I'm not afraid to die. I'm not afraid to die. But I want to die in my home. I do not want to die in a nursing home. I do not want to die in a retirement. After COVID, our product got even more popular. After COVID, our product got even more popular, where sometimes there's people like you in the room who have elderly parents. They are living in this $1 million property in Scarborough. They're struggling. You have 2 choices. You can sell the home or maybe put them into a nursing home or a retirement home. Those things cost an arm and a leg. 5,000-6,000, maybe even more. It's cheaper for you to get care home. So I have people approaching us saying, listen, mom and dad are struggling. I've been paying out $3,000 on a monthly basis just to keep them going. Can we do a reverse mortgage? Because they don't want to move these people from their home. That's the community that they lived in. That's where they want to die. So gone are the days where there's a stigma. There's occasionally a greedy child somewhere. Oh, I don't want mom and dad to take a reverse mortgage. It's eating into my inheritance, right? Let's face that too. What is the only one downside to a reverse mortgage? It's eating into someone's inheritance. That's it. That is it. But your home is also an appreciating asset. So you can let mom and dad starve, not do anything, right? It's a choice, right? But the other one, sorry. Show me the money. There you go. Exactly. Few more slides and I'll open it up for questions. I'm sure you'll have a lot of questions. I'll keep it there.
Keep it, okay.
Yeah. So to your point, no negative equity guarantee. Okay, this is a phenomenal guarantee. Why? Because I gave Andrew $100,000. Andrew decides to live till he's 200. Okay, he's good genes. So, and he owes Equitable Bank $2 million. He passes on, sadly. He decides, his estate comes and says, oh, I need to sell the home. Yeah, okay. The home is worth only $1.6 million at that time. I give it in writing that the estate will not be liable for the difference, the shortfall. Now, we are a very smart lender. We lend 59%, you would be in your 80s. Hasn't happened, but it's a good protection that we are giving. Why? Because now the kids, otherwise sometimes the perception with kids, oh, mom and dad will take this reverse mortgage. They'll owe millions of dollars to Equitable Bank. When they die, Equitable Bank is going to come after us. No, Equitable Bank does not come after you. Okay. Spousal protection. This is an amazing one. This is an amazing one. God forbid, husband and wife take a reverse mortgage. One person passes on. The other spouse can continue to live in the home they love. Nothing changes to that contract. Nothing changes to that contract. With a typical mortgage, you are in default. TD Bank is not going to come and say, okay, pay up. But TD Bank can do a number of things. If they had a line of credit, they can say, okay, now you don't have access to any more funds. We demand a certain payment. So it can have other implications. And you are technically in default of that mortgage. The reverse mortgage, we offer what is called spousal protection. One spouse passes on, the other spouse can continue to live in the home they love. Nothing changes. Remember my comment that we qualify based on the younger spouse. So when we look at this, if a husband is 79 and the wife is 70, our quotation will be based on the 70-year-old, because the chances are that spouse will outlive the other spouse. So we base it on the lower spouse. Next page, please.
What if she remarries?
That is an issue.
I'm not going to remarry, but what if she remarries?
Well, it has happened. If she does remarry, we have to requalify the deal, right? Or I have had scenarios where let's be honest, he's 80, trying to get married to a 40-year-old. No, then the mortgage is due. So I say two things. One is either you can have the reverse mortgage or have the 40-year-old wife. So you make the decision. Like, hey, we are bankers, right? So we don't make the rules, and they can do whatever. Next page. Sorry, I think they're going backwards here. Okay. Yeah, this is important. Okay, this is sadly true. 20% of retirees are still paying for mortgages. It's sad, but true. You might know some people like this. Okay, these are people who have retired. These are people who have worked extremely hard, right? Came in here 30 years, 40 years, maybe, I don't know, whenever. They retired or they were forced to retire. Companies are doing that quite a bit as well. They're forced to retire. They worked at GM, they worked for 30 years, whatever. They still have a mortgage. Sad. They're finding it difficult. We can help. 66% of retirees are still paying a credit card debt. Sad. 66%. 7 out of 10 Canadians over the age of 55 are still paying a credit card debt. Think about that. It's a fact. If you get a $2,000 credit card advanced by TD Bank and you spent the entire $2,000 today and you just only make minimum payments, you know how many years it will take you to pay off that credit card? 21 years. On a $2,000 credit limit. If you make the minimum payment. That's why now if you take a look at your statement, next time you if you're making minimum payments, it will tell you, if you continue to pay the minimum payment, it will take you 13 years and 10 months to pay, right? It's sad, but this is big. 42% of these people are also homeowners, which is a good thing, right? 42% of people over the age of 55 are homeowners, which is fantastic. And those people are house rich, cash poor, but I say they are rich. Next page, please. We sort of covered some of these. 90% of the people want to age in place. And when I say age in place, they want to stay there. This is a stat, so I'm not disputing yours, but which Equitable Bank has, I think this is a 20-year period, 6.9, and 51% have a strong resistance to move out. Okay, let me cover off a few examples, and I know I would like to take some questions. So we'll talk about right sizing, divorce, early inheritances. Next slide, please. This is important. This is an important slide. I just want people to understand so that most people in a room would be visual, right? Today, this is a real example. Today, if someone purchased, let's say, 80-year-old female, we lent her $300,000. Okay, her home is worth $1 million in Scarborough. Okay, so right here, if you look in the first line, 1 million minus of 300,000, she'll have $700,000 worth of equity. Everyone with me? Go. Year one, how much will she owe? Right, this is an actual interest rate, 674. She'll owe after year one, $20,000 worth of interest. Now, you might look at it, whoa, that's $20,000. Yeah, but whoa, she didn't make a single payment. Okay, so you have to put that into perspective, right? How much if you were to make a payment on a $300,000 mortgage, average $2,000, that's $24,000 a year. You'd have to make out every month, and you have to qualify. Okay, she didn't make any payments. Now, if her home appreciated at 3%, she will now in year one, her home is worth $1,030,000. She owes $320,000. She has home equity of $709,000. Let's fast forward this to 10 years. 1.3 at 3% appreciation. How much will she owe? 300 plus 290. So it pretty much doubled. $600,000. She still has $753,000 worth of equity. So this whole perception of all my equity is gone, that's not true. Now, it can be true if the whole market tanks and everything just goes sideways. Tell me which boat you're getting into. I'll get on the same boat with all of you guys. Like everything has crashed, right? But you still have a no negative equity guarantee. Okay, next slide, please. Go to some case studies very quickly. I'll just go over, right? Reverse mortgage for purchase. Realtors don't think of this, but it happens quite a bit. It's becoming more and more popular. Example, right? You're laughing, sir, right? Yeah. Very quickly, high level.
The dancing.
Right? People are living large, right? You remember? Like, you know? So, sorry, lost my train of thought. Okay, this house in Scarborough sold for $1 million. They had a $300,000 mortgage. Let's assume none of you charge fees. So 300, 700, they'll end up with $700,000, correct? Million sold for $1 million, $300,000 mortgage. They'll net $700,000. Now they're right sizing. They're buying in Scarborough again, but they're buying for $800,000. So they're downsizing, right sizing. They come to you, you got them this beautiful house, then you send them to Warren. Warren, my clients are looking for a $100,000 mortgage. Oh, he says, oh, fantastic, I'll help you out. What's their income? Oh, all they have is CPP and OAS. Sadly, he can't get you approved. However, he can get you approved, possibly based on their age, for a $300,000 reverse mortgage. Majority of the time, when they go now, when you present that case to that customer, their need was originally 100, but they qualify for a $300,000 reverse mortgage. They'll say, listen, this is a good idea. Once they get to know, understand it, digest it, they'll say, I'll take a $200,000 reverse mortgage. Then you know what they do? They have $100,000 in the bank because they took 600 of the sale, a 200 reverse mortgage. They accomplished what their dream was, to get that $800,000 home, and they have $100,000 in the bank. Next slide, please.
And this is the one we are seeing a lot. They don't even want to keep up a small mortgage payment. If you have a CPP and if you have a property tax, maintenance fees, and 6%, even if you want to borrow the bank as well. Right?
Absolutely.
So some of them have the cash flow problem. So most of the reverse mortgages I have done with the Equitable Bank is like a small $150,000 mortgage. It makes you guys to move the property that you were not able to move it.
72.
Sometimes, sorry, sometimes the kids don't want to co-sign that.
Yeah.
They don't want to go the mortgage. They don't want to be responsible for the payment. They say this may be the better option. We kind of explore that option before we got.
Absolutely.
Sometimes they don't want to.
Yeah. It's very simple. I mean, right now, if you ask a client, let's assume that they qualify. If I ask any one of you, if you have a $500,000 line of credit with TD Bank, roughly you'll be paying interest only around 7.2%. right? Prime plus something, roughly 7.2. And you have to make an interest-only payment. If I tell you, I'll give you a $500,000 line of credit with a minimum of interest-only payments at 7.2, interest-only payments, or a reverse mortgage. Let's assume that you qualify for a reverse mortgage at 684, no payments. I'll win every single day, right? But it's just a matter of being able to get over the perception. Vacation or income property, true story, live story. Maybe 6-8 weeks ago, this lady was looking to liquidate, wasn't sure because she was having cash flow issues, had spoken to her children, went to a realtor. And actually the realtor, she wasn't ready to sell. She had a condo in Richmond Hill, beautiful condo, right? Worth like $1.3, $1.4 million. She qualified for like a $500,000 reverse mortgage. Guess what she did? She went and purchased another condo, not in the same building, somewhere else. Now she's collecting $2,500, $3,000 worth of income. So she was not ready to move. And the realtor looked at this and said, okay, you're not ready to move, but here's an opportunity where we can create some cash flow for you. Okay, like I said, it's not for everybody. You're leveraging a home, but it's not for everybody, but it's available. Next slide, please. Few more slides and then I'm done. Questions after that, right? Gifting or early inheritances, right? This is happening more and more and more and more. We had this conversation before. I'm going to use my own example of my son. I'm really proud of my younger son. He just qualified as a aerospace engineer. He graduated from McMaster University just a few months ago, and he works for a company called Pratt & Whitney, which is one of the top engineering firms. He's an aerospace engineer. He's 22 years old, right? He makes amazing income for a 22-year-old. Runs an amazing broker, but he can't get him a mortgage. You know why? There's zero income, zero down payment. There's debt, student loan debt. There's amazing income unless the bank or mom and dad help him. Now, 50% of the down payments today, 50%, this is a CMHC stat, are coming from the bank of mom and dad. Not all reverse mortgages, but mom and dad are cashing out investments. So my son cannot get into the housing market unless the bank of mom and dad help him. Not even in Hamilton. No chance. He cannot get a home. Right? This is happening more and more. I can tell you financial planners are leveraging this amazing because they know who their high net worth clients are. If you have a high net worth client who owns a home, let's say free and clear, and they have, I don't know, 3, 4 children, grandchildren, whatever. This financial planner asks an amazing question. He asks all his high net worth clients a very simple question. Have you considered giving an early inheritance to your children or grandchildren? So the question is, have you considered giving an early inheritance? What's the answer you get? Yes, no, maybe, I don't like my kids. I mean, it's an open-ended question, right? They are losers, whatever. But you open up a conversation. Majority of the time, they say, tell me more. Tell me more. And once they say, tell me more, that's your opportunity to say, okay, here's what it is. They can leverage it. And financial planners, so if you're working with financial planners, tell them, listen, you have access to one who has access to reverse mortgages, right? These are for your affluent clients who are sitting on tons of equity. They can leverage it for purchasing. Next slide, please.
What about tax implications?
No tax implications.
See, like, you're keeping out equity, $1 million equity.
Tax-free cash. It's your,
Give it to them.
you're giving it to them.
Yeah.
That's a gift. Once, if they put it in the bank account and they start generating income from it, that becomes their issue. But it's from your primary residence. There's no tax implications for them. And they're gifting it to someone for purchase. I'm not a tax expert. I'll stop at when they take the money out, there's no tax implications. Okay. Great divorce, sad, but happens. Sad, but happens. Yes, ma'am. Yes, yes. You have to be 55 years of young to qualify for a reverse mortgage. Only. I can qualify. Yes, I can. And I will consider. Absolutely. Absolutely. Right? When my wife and I decide, would this be the option? Sure. We might decide either that, sell a house, whatever. Right? Great divorce. Sad, but true. Great opportunity for realtors. Great opportunity for realtors. Right? Why? Because you get 2 sales out of this. Right? Simple example. $1 million home, Scarborough, they're splitting. Both end up with $500,000. What can you buy for 500? Nothing. They want 700. They're both purchasing for 700. Amazing opportunity for you. Hey, they both qualify for reverse mortgages. Talk to Varun. He'll be able to help you. You get 2 sales out of it as well. Next page, please. work with this young man. He has access to some amazing material. All you need to give him is this. My clients are 72 and 74. Give him the ages. You don't have to give him the names. Their property is in Oakville, worth $1.3 million. How much would they qualify for? He'll give you an amazing snapshot of A, how much they can take out, B, to show if you borrow 300,000, what will it look like in 5 years? What will it look like in 10 years? That's the biggest question people have. What does it look like in 5 years, 10 years, 15 years? He can give you an illustration to show what it looks like in 15 years. It will also show how much equity will be left if your home appreciates at 5%, 3%, and 1%. Right? That's the question people have. Two things. One is, oh, the bank owns the home. Break that myth down right away. That's absolutely not true. Right? And ask them if you did a mortgage. Did you have a mortgage at TD bank? Yeah, I did. Did they own the home? No. Oh, okay. It's the same thing. Oh, okay. You're good. Right? So he has access to all that information. All you need to give him, ages, address, property value. He'll give you an amazing financial illustration. I sincerely thank you all for your time. I really appreciate it. I'll open it up for any questions, comments, concerns. And if you think it's garbage, I'm prepared to defend it as well. Right? So just fire away any questions that you have. I'm willing to take it on. I came with my bulletproof vest. So
I've got 2 questions.
yes, sir.
First one is, you registering a mortgage on the house to protect your position?
Yes, we do. We register a.
Can you take second position?
No, we cannot.
So these houses have to be mortgage free?
No, we can pay off and absorb the existing mortgage.
What if it's more than 59%?
Then I can't do it. Sorry, let me.
So my second question is, does it have to be a lump sum payment, or
Nope.
can you give them monthly allowance?
Amazing question. So I'll answer this in 2 parts. Let's say they had a $300,000 TD. I'm going to cover off a part of your first question as well. Right? This will answer some of your part of your. Let's say they had a $300,000 reverse TD bank mortgage. Okay, they're 80 years old. They live in Scarborough. They qualify for $500,000. Now, TD bank mortgage is coming up for renewal. Okay, the next 2 years. Their payment on the 300,000 would have been, I don't know, $2,800. Now it's going up to $4,000. They can't afford to. They can afford to take a reverse mortgage. We'll give them 500, or they're approved for 500. We pay off the TD, just like that. They don't have to make that monthly payment anymore. Cash flow in their pocket. To your point, they don't have to take, they were qualified for $500,000. They don't have to take that whole thing. They can say, listen, I want to use this as an annuity. We pay off the TD bank mortgage. I'll take 20,000 bucks or whatever it is, just keep it in a bank account. Give me $1,000 a month. No problem. I'll give you $1,000 a month. Do they pay for interest which they haven't used? No. On a line of credit or a credit card, if you don't use that credit, you don't pay for it. You'll only pay for what you use. Right? So does it answer your question? Now, to your point, if they owe more than 59, sorry, I can't help you. And I don't want to help those people because you know what? Our risk position, those people, if their mortgage comes up for renewal, sadly, they'll have to sell. Right? Do we allow seconds to go behind us? No. And I'll tell you the reason why. We would never, ever want to kick out a senior from their house. Never. Right? We lend based on what the risk is. Right? So we don't want to see them in a position. When we do a reverse mortgage, we want to make sure that these people's income, cash flow, and their well-being and life become better. And that's a true fact. I'll walk away from a deal. Right? Brokers call me, like, you know, if it does, sadly, no, I can't help these people because there's no exit strategy for them. Right? They may be best off selling. So you cannot do second mortgages. Any other questions?
Can I comment on that? So we had a client, we had a $1.2 million reverse mortgages on it. The reason being, she helped the son to start up a business in Vancouver and the business miserably failed. And she was carrying a $1.2 million line of credit or $100 million line of credit. The payment went from 2% interest rate to 8% interest rate. So she couldn't keep up the payment. So we had to do a reverse mortgage to pay that off. So those are some of the situations.
Exactly. And she didn't want to move from the property. She didn't want to liquidate. Right. So that was the scenario there. So thanks for sharing that. Any other questions?
You have someone online that said,
Sorry.
can you buy an investment property with reverse and write off the interest even though there are no payments?
I'm a banker, so I'm going to say yes and no on that one. Here's my official, well, actually, this is being recorded, so check with your accountant. I'm a banker. Check with your accountant. You'll be able to get the answer for that one. Thank you. No, the question is, if I buy a reverse, if I buy an investment property, can I write off the interest?
They take the money from the principal home to buy it.
Yeah. What's that?
Well, the mortgage, take it out on the-
Yeah, but the question is, can you write
Can you
off
write it
that,
off?
write off the interest? So, check with your accountant. Next question, please. You had a question? Yes.
So if both spouse pass away,
Mhm.
so the property has to be sold, right?
Doesn't have to be sold, but okay, the mortgage becomes due. Yes.
Uh-huh.
Okay.
Okay, then you said you don't have to. What do you mean?
Okay. So before you answer that question, I'm going to pose it in a different way so that you, if they had a TD bank mortgage
Uh-huh.
and they both pass away, what happens?
Never to know.
If you have a regular mortgage, any mortgage, if the title holders pass on, that mortgage becomes due.
You had recall.
Now, it may be belonging to the children because mom and dad have written this to the children. They'll go to Varn, right, or they'll come to you and they'll say, mom and dad have passed on. We are still looking to stay in this property. No problem. They work for Rogers Cable, whatever. He'll do a regular mortgage at Scotiabank or with Andrew at Equitable and pay off the reverse mortgage. It's the same thing. Or they can sell the property, the estate can sell the property, pay off the TD bank, or in my case, the reverse mortgage, the remaining money is theirs. Does that answer your question?
Second question.
Just add to it, is there insurance package?
No, there is no insurance package. And even if we were to look at it, it'll be very expensive because, think about it, on their age. Now, they can go and buy a standalone policy. Sure, they can buy a standalone policy, but, we do not. I mean, I used to do creditor insurance, but it's too expensive on this product.
Second question.
Yes.
Okay, now I understand what you meant is when the time the property being sold, normally the value should, because of the appreciation in the property, right? So normally the value should be higher than the interest owned.
Sure.
But say, for example, so unluckily, say 1996, the market dropped half,
Mhm.
right? The property, then if this is a situation, what happened then?
So is your question, they owe $500,000, but their property is worth only 400?
Yes.
No negative equity guarantee. I will take the loss.
Oh.
Equitable Bank and Andrew and I might not get paid, but so we'll start, but no, no negative equity guarantee. Remember
What does it mean? No negative guarantee. No, what do you mean?
if the client decides to sell, let's say they've got a reverse mortgage worth $1 million today, they decided to sell in 5 years' time.
Mhm.
They borrowed 500,000.
Mhm.
They owe us 600,000.
Yeah.
In 5 years' time, that property value has declined now
Mhm.
from $1 million to 400,000.
Mhm.
They'll owe me 200, right?
Yeah.
No negative equity guarantee, which means they sell, their estate will not, or nor them will owe anything to anybody. They'll walk away from the house, they'll sell, we will absorb the loss.
You stop. Okay. Okay. And the third question is, as far as I understand, so this interest is compound interest, right?
Compound semi-annually, just like a regular
Compound-
mortgage.
compound interest. But like Claire just asked you, if the mortgage not take in lump sum, but in like the partial payment or monthly payment, so that partial payment, right, monthly payment, whatever, would it be also the interest price? Would it be according to whatever amount you take each month?
Sure, it'll be just like a line of credit. If you have a line of credit, you will get qualified at TD Bank for $300,000. You take out 100,000 today. I don't know. Next month you decide to take another $20,000. Whatever the rate is, because it's at a variable rate, prime might have moved. You'll be paying interest on that 100 plus the 20. So it works just exactly like a regular
Depends
product.
on how much you take.
Absolutely.
Okay.
They don't pay for the remaining amount.
Another question. Just to clarify, Like he mentioned about, say, for example, one spouse passed away, okay, and then the other one remarried with a young girl or
Mhm.
something like that. So how does it affect the reverse mortgage though?
They are in default of the mortgage, that mortgage is due,
Oh,
so they can either pay us off at that time.
you mean that time the mortgage has to be paid?
Yes, now,
Ah.
I don't want to get too technical here. They can still do a reverse mortgage only in their name. Their new spouse can get independent legal advice saying that she has no rights to that property. So there's ways to overcome that. Guys, let's not get too technical. Those are great
Because I
questions.
need to know, because
Absolutely.
we need to be clear.
Yeah,
about
Absolutely.
this.
Call Varun, he'll be able to
Yeah.
clarify all those. If you have technical questions. Yes, sir, you had a question over there. No, I saw you raise your hand. Oh, no. Okay,
So-
sorry.
So in other words, the new wife can move in, right? But she's not entitled for the whatever amount if in the near future, if the person sold any profit, she's not qualified to get the profit only, right? But she can move in, but they don't have to sell the property, right? She can move in, do whatever they want. That mortgage is due. Now, we don't know what we don't know either. Okay, so it's the rules are the same. If they divorced and whether it's a TD Bank mortgage or they're technically in default of that mortgage because now the wife is supposed to be living in that property, right? So at the end of the day, she can move into whatever. That mortgage is due, right? Yeah. When if one spouse passes on, if they get remarried, right? Because now that the contract was originally done for him and the wife. So one party passed away, then the other one remarried.
Other one can continue to live in the home as long as if they do get remarried, then the mortgage is due.
Oh.
We don't get that information unless we find out. Usually trigger point, I don't know what I don't know. We are not going to check with it. No, occasionally at renewal, we might send a questionnaire, right? Saying, hey, listen, send us your property tax statement to show that it's paid up, right? And on the questionnaire, it'll still say, are you still, what is your marital status? Like, yeah, happily is good. Like, with whom, like, yeah. Well, I beg your pardon?
Verify that I'm happily married.
Yeah. I mean, that depends on, yeah, exactly. So it's, I mean, we are a bank, like, you know what, guys, like there's a lot, if we don't know what we don't know, we don't know what we don't know, right? But if we do get to know what it is, then your mortgage is in, most common default is property tax arrears.
Now, when it comes time to sell a property, you can pick and choose who you want to sell it with. Equitable has nothing to do with that.
We leave it with you lovely
Unless
folks
you
here
take-
to
unless you
do.
take over the house,
Yeah,
you
yeah,
guys
yeah,
do your-
exactly. We don't take over unless they are in default, and we would never, yes. But otherwise that will be,
The chances of these guys are taking over the property is less than a bank taking over the. property.
absolutely. Very rare.
They don't make payments.
Sorry, hold on. This lady has a question.
If they don't live there, or they own money on property tax, what is the thought there?
You have to maintain the property, maintaining the property. Yeah, exactly. Like if there's a big hole in the roof, you know what, we are concerned now, like either get it fixed or so maintaining the property. Very good. And job at Equitable Bank. We do have the right. Sure. Do we do inspections? No. We'll do an appraisal upfront at the beginning. Yes, sir.
Any complication for you guys if, income tax, people take the house and sell it, and there's not much equity there. Or do you qualify if they owe some money to the?
Income tax, Revenue Canada?
No,
We don't know what we don't know. So unless the broker discloses it, right? Now, if they have really, really poor credit and they come to us, they still own a home. Here's the bottom line. The bottom line is this. When we look at a reverse mortgage file, we look at a few things. Can we help this individual or individuals have a better life by living in their home? Would we ever have to kick them out? If the answer is yes, we'll walk away from it. We'll decline it. If they owe CRA $700,000, CRA hasn't still come to them, we are not going to do that reverse mortgage. Now, I was telling Baron, I have a case where the gentleman is 85, son is 60 something, they are both on title, they owe 7 years of property taxes. I don't know how he got away. there's a story there, and we've looked at the story, and the story is that this gentleman just didn't know. I mean, he has touched it, like and he just went. Maybe the city didn't act either, because that's a story. Can we help that individual? Do they want to still live in the We will pay the property tax arrears off. Yes. Right? Will we monitor that property very closely? Yes, we will. And as long as the son makes an undertaking and proves to us that they are paying the property taxes on a month, will we do the deal? Absolutely, yes. We want to help that individual. We're not going to discriminate, because, I've had situations where people have 6-7 months to live and they want to do a reverse mortgage because they want to have a better life or whatever it is for this. Sure, I don't care. I don't ask you. Yes, there'll be penalties, but if they pass on, there's no penalty either. So if we can make it better, sure, we'll make it better. Yeah, happens.
What happens if somebody sell the house while they already took the money from you?
What happens if they had it?
1 second.
Okay.
To his son for $2.
Okay,
And
so they sold the house for $2. Okay, so then they have to. You tell me. If, how can they sell it? They have to
Yeah,
they have
you
to
guys aren't
pay
doing
us off. They're the TD Bank mortgage and they sell it.
sometimes they did already, but sometimes they even know.
It's on title. When they go to register the mortgage, the lawyer register such as title, that's going to say, yeah, the mortgage lawyer will say, oh, there's you owe Equitable Bank. What are you going to do with it? So then the son has to pay it off.
Do you guys have to sign like listing documents and all that too to put it on the market if
No.
you're entitled?
No.
I think where is going to help you guys is when you downsize it, the client may need a small mortgage, 100 days, 200 mortgage. Sometimes they don't want to do a transaction. I think Equitable Bank, the reverse mortgage will help you to do the transaction, move them to a dream home or get a better lifestyle.
Right, over to you. Thank you so much again for your time. I hope all of you learned at least something about a reverse mortgage. Like I said, he is the expert. He's done lots of reverse mortgages, right? Their brokerage is amazing in terms of doing reverse mortgages and other mortgages. And I don't need to tell you about it. Reach out to him. He can get you illustrations. He'll be able to tell you way more, right? So thank you for your time. I appreciate it.
Thanks, Pat.
Thank you, guys.
You okay? All right, thanks so much for doing this, guys.
Thank you. I know I went over my-
We'll check
I
off our
apologize.
offline people. See you later. We'll put this up on YouTube for you guys.